Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, we're working on your financial freedom. On today's show, we're going to answer a question that was sent to me over the weekend. This is actually a very good question, and it appears to come from somebody who's younger, who's trying to figure out how to get involved with real estate investing. And they reached out to me as a source of information. And what I'm going to do on today's show is I'm going to ask their question so that you and I can learn from what it is they're trying to find out, and I can impart some insight as to how we do business with real estate investing, because at the end of the day, that's kind of what our culture is at Lifestyles Unlimited. We are real estate investors who joined for the education and mentoring services that are available through the company. We change our lives by following the teachings that Del Walmsley put together over 30 years ago. It's going to be 31 years in September. So, I mean, this stuff is time tested and it works. I mean, it worked 30 years ago. It's working now. And what stuff am I talking about? Well, I'm talking about the investment of your hard-earned money into an asset class that your financial planner didn't tell you about. Yeah, real estate. Your financial planner is not going to tell you about real estate because, first of all, they don't make any money when you buy real estate. No, they make money when you take your money and give it to them in some type of retirement plan or whatever you got set up with your financial planner. And then they put that money usually in the stock market, maybe in the bond market, maybe somewhere else, depending on what you told them you wanted to do. And they make trades in those markets and they get fee income from doing so. And I'm not saying that they're wrong, or I'm not saying they're ripping you off, because that's not my point. My point is your financial planner is not going to tell you about real estate investing because that's not their lane. That's not what they know. Yeah, it's just the way it is. That's kind of why I exist, to inform you of something that society hasn't bothered to tell you about. Yeah, at the end of the day, that's the way it works. So let's get into this letter. Hey, by the way, if you want to send me a question or even a comment, whatever you want to do, at askal@luinc.com. That's askal, ASKAL, at luinc.com. That LUINC stands for Lifestyles Unlimited Incorporated, but don't write it all out. Just use LUINC. So this email I received over the weekend, pretty good email. Let me just get into it. My boyfriend and I are actively looking for our first investment property, specifically a small multi-unit home to house hack. You may be wondering what this house hacking thing is. House hacking is kind of a concept where you buy a property and then you start renting out rooms within that property to people you either know or you don't know. And it's a methodology that younger people are using to try and acquire property, to try and get into that first investment deal. So, it's a strategy. It's not one that I would pursue, but it's one that people are pursuing, especially people trying to get started in real estate investing. Now, we don't teach house hacking. We don't teach that because in our lane, so to speak, we kind of find that as being ineffective. But for some people in some markets, it might make sense. We just don't believe that's the correct way to invest in real estate. But let me get back to the email that came in. We have spent the last year educating ourselves and practicing property analysis, doing market research, getting required documents and forms prepared, etc. Okay, so it sounds like they've spent a little bit of time. They've been educating themselves. Now, they didn't indicate where that source of education was coming from, whether it was coming from an organization like Lifestyles Unlimited, where we give you everything that you need, all organized correctly. All you have to do is pay attention and follow what we teach you, and you'll do fine. You'll do better than fine. Or maybe they're going to some of these message boards and, asking random questions here and there. I don't know where their educational source is. So that's one of those questions I'm going to fire back. Hey, where have you been looking? Because the reason that's important is that information it's garbage in, garbage out. You remember that thing, GIGO? Anything that you ask, especially on the internet, can be responded to with great information or not so great information. It's just the way it is. Now, they said they've been practicing property analysis. I don't necessarily know what that means, but I'll talk a little bit about property analysis on today's show. They've been doing market research. Okay, so that tells me that they're at least trying to hone in to some market, but they didn't indicate to me where they live, and they didn't indicate to me whether or not they want to invest in that area or in a different area. Now, I will tell you that we have members at Lifestyles Unlimited that invest in certain markets because those markets have the potential to produce great returns. And those certain markets aren't anywhere close to where these owners live, because what we teach works anywhere. We believe in the concept of live where you want, invest where you want. Yeah, I mean, trust me. I've got a lot of fellow Lifestyles Unlimited members that live out in Florida that invest in Texas. And the reason they do that is because the numbers make sense in Texas. The numbers don't pencil out for them in their local region. And because they're property educated and they've built a solid team, they do just fine. They do absolutely fine. They get the cash flow, they get the equity growth, they get everything that they're trying to get out of that property. But back to the email. Recently, we've been thinking of what our strategy will be going forward after we purchase our first property and get ready for the second. Okay, a little bit behind the power curve there. You really should be thinking about that strategy before you buy something. Our goal is to be financially independent in 10 to 15 years and solely work on our properties. Okay. Yeah, we can definitely get you there in 10 to 15 years. We can potentially get you there in 5 years. And, when it comes to solely working on your properties, well, you're going to have a lot of extra time. And I'll tell you what I mean by that when we come back from the break.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Welcome back to the show. So I'm answering an email that I received over the weekend from a couple. It's clear that they're not married, so because they said my boyfriend and I. So, that's what I get out of that. So the reason I bring that up is there are certain things that you probably need to take into consideration if you're planning to invest with somebody who you're not married to. Now, marriage provides certain protections and certain benefits under state law, depending on where you live. And I'm not trying to be an attorney, so please don't think that I'm trying to be an attorney. All I'm saying is that if you're going to invest with somebody else that you have a potential romantic relationship with, and there is no marriage there, you may want to consider talking with a real estate attorney as to the proper ways for you to hold title. Yeah, because, everything might be fine and dandy today, but who's to say in 3 years whether you guys are still going to be together? And I'm not saying you're not. I'm just saying you never know. Things happen in the future. Things happen between people. Anyhow, the rest of the email basically says, and let me just give you a synopsis. So what these folks have been doing is they're wanting to get into their first property. And they brought up this term called house hacking. I don't think house hacking is potentially a good way to go, but maybe for some people, that's how they have to get started. So I'm not saying you shouldn't do it. I just think that there are other ways to get started that make more sense. And really what it boils down to is how much capital do you have? So they've been educating themselves. We're not sure where their education has come from, but they're probably reading books, looking at the internet, whatever. They're getting information. So they're getting potentially good information, but they might be getting some bad information too. They're practicing property analysis. They didn't go into what that is. They're doing market research. So they're, hopefully looking at the right market research, indicating what the trends are in the communities that they're planning to invest in. Also, having a good understanding of what those communities are doing to grow, to attract jobs, to attract the things necessary for a robust and functional society, because it is very, very good to invest in places like that. Okay, so they say, we're wondering to hear about how to get started and what strategies such as debt snowball, trade up, short-term, long-term hold, BRR, etc., have you taken to grow your portfolios at Lifestyles? Also, any tips or advice you would like to give to someone just starting out? We're working with about $60,000 to get started. Okay. So actually, I've got some good information to go with here, and that's important. Let me just tell you this. The first thing that you need to do is to spend a little bit of money and get a qualified, comprehensive education on how to invest correctly. The model that we teach, that Del Walmsley put together 31 years ago, is time-tested, it's proven, it works. As a matter of fact, he's had students that are a part of his program kind of branch off and essentially teach the same information. So it just tells me that it works. I know it works because it works for me. I know it works because it works for my fellow Lifestyles Unlimited members. I'm just, I'm not trying to turn this into a commercial, but I guess I am. So let's get back to this question. So they use a term called debt snowballing. This kind of gets into the fact that they've looked at different strategies. So debt snowballing is a concept where you line up all your debts and then you knock one out as quick as you can, and then you move on to the next one, you move on to the next one. I think debt snowballing is a great way to tackle consumer debt, because consumer debt is terrible debt. It is debt you shouldn't have. You really shouldn't. And if you do use credit cards, you should pay those darn things off every month. And the credit card companies don't like me saying that, but if you look at the interest rates that they try and charge you, the crazy interest rates. Even if you've got a low interest rate card, it's still crazy when you consider that you can get a mortgage for a rental property at 3.5%, 4%. I do agree with getting rid of that consumer debt, because that doesn't help you. But when it comes to real estate debt, I'm not a big fan of taking all the money that you have and dumping it into equity in a property, because that's essentially what you're doing is you're paying down the debt because you're worried about paying costs, or you're worried about having that debt 30 years from now. Don't do that. Don't worry about that. Leverage the property correctly. And I'll talk a little bit about that later on in the show. Another strategy they brought up, trade up. Okay. Yeah, I think you should trade up. I think you should buy the right properties, but not from the standpoint of you start with a 1,000 square foot house, and then your next property is a 2,000 square foot house, and your next property is a 3,000 square foot house. No, I believe that you buy one house and then you dispose of that house somehow, either by selling it, or maybe you retain it and you refinance it, and then you buy two more houses. And then you own those for a while, operate those, and you turn those into four more houses. And I'll get into that a little bit later on in the show too. So what you're doing is you're trading up in quantity, not necessarily in price or size of the property. So I think there's an important distinction there. I also think that there's a certain point where you transition from single family properties into multifamily properties. I mean, that is part of an overall strategy. Now, we do have members at Lifestyles Unlimited that own over 100 single-family properties. That's their modality. That's what they love doing. That's what makes sense to them. And I'm not saying they're wrong, because clearly they own over 100 properties. I'm just saying that the natural progression for a real estate investor tends to be transitioning from single-family assets into multifamily assets. And the reason for doing that is there's a lot of reasons. There's the ability to force appreciation in multifamily. You get economies of scale. Instead of having properties geographically dispersed, you have units that are co-located in one place. I mean, those are some of the reasons. They mentioned short-term, long-term hold. Okay, so short-term hold is really flipping. That's when you go in, you find a property, you buy it, you renovate it, you put it up for sale, and then you sell it. And your total time in that property is less than a year. The IRS basically says you're self-employed. They impose full Social Security and Medicare taxes on the gains, and whatever gains that you do make, you will pay your tax rate at whatever your ordinary tax rate is. So it is a method that can generate cash for you, but also understand that there are many people that find that they make good money flipping, but then they trade in whatever they're doing for a full-time job for a full-time job of flipping. Remember, one of the goals of real estate investing is to get to a point where your investments are doing all the heavy lifting for you, that you're not spending a lot of time focused on those investments. And our map helps us to create that environment. We come back from the break. I'm going to talk a little bit about the long-term hold and the BRRRRRR. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the show. So I'm realizing I'm getting a little long-winded here because we're already into the third segment, and I kind of expected to be into some of the numbers for you. So thank you so much for dealing with me. But I think the information I'm putting out is important because it's what I'm trying to do is let you know that there are different philosophies out there with regards to real estate investing. And if you're just getting started, I mean, if you're just thinking about this and you're like the person that sent me this email, you're in education mode. You're trying to figure out what makes sense. And you're getting a lot of advice or you're reading a lot of things out there that paint a certain picture for you. And I'm trying to be nice. I'm really trying to be nice. But some of those pictures are not very good. And some of those folks that are out there that are trying to sell you the secret system for real estate investing, you just have to be wise about what you're choosing. So that's just my 2 cents for you. Now, when it comes to long-term hold, that's one of the things that we do believe in at Lifestyles Unlimited. And the reason we do believe in long-term hold for our properties is that it gives the properties opportunity to increase in value. It also gives the properties opportunity to generate cash flows for us. And those are very important. Very important that whatever you choose to do and whatever you choose to buy, it must cash flow. If it doesn't cash flow, walk away. And I would tell you that my minimum baseline for anything I would invest in is at least $200 a month. Now, I prefer to see higher cash flow. That's just me. But depending on the deal, depending on what the deal brings to the table, I might be willing to consider a property that produces lesser cash flow, but I may be able to, say, grab greater equity. And it boils down to where I'm at in my investing strategy. What is important to me for my next investment? Do I want greater cash flows? Do I want greater equity capture? Do I want a balance between the two? It's really where my mind is at. And it's based on a long-term strategy that I put together. Now, there's a thing called the BRRRR. I think there's just 4 of them. But basically, the BRRR is the concept of buy, rehab, rent, refinance, and repeat. And that pretty much sums up what we do at Lifestyles Unlimited. We find properties that are distressed. We buy them. And I'm not saying Lifestyles Unlimited buys them. I'm saying the members of Lifestyles Unlimited buys them. See, at Lifestyles Unlimited, we don't put any money into any of our members' deals. That's not how we operate. We create the framework for our members to do business, but there's no Lifestyles Unlimited capital going into, say, Al Gordon's deal. Does that make sense? Okay. So buying, rehabbing, renting, refinancing, and repeating is a model that works. It is a model that works. Now, it does require an education. You do need to learn how to correctly rehab properties. And you do need to learn how to correctly build a team that will do these things for you, because rule number one is actually don't lose money. But one of the rules that we live by is work on your business, not in your business. And for a lot of people, that's a concept that's difficult to grasp. It is, because we're all from that middle class mindset. I mean, that's what we've been taught growing up. We've been put into the cog of the machine, so to speak, or we are the cogs in the machine, and we do what the middle class does. What Lifestyles Unlimited does is it teaches you a way to get out of the middle class and to where you've been trying to get to for the majority of your life. So what I'm going to do is I'm going to talk about an investing strategy that uses the BRRR method and is a long-term approach. But when I say long-term, it doesn't mean we're going to own these properties for 30 years. No, the approach that I'm looking at is a 3-year hold. And it involves buying distressed properties that have been neglected for one reason or another, or maybe they're distressed because of legal actions against them. Who knows what's causing it? But the majority of the stuff that we buy, it's usually deferred maintenance. It's the fact that the properties have just been owned and just kind of run down. Nobody's taken care of them. Nobody's put them back to their glory days. And that's what we do. So this person indicated they had about $60,000 to invest with. And that's actually a good number, because there's a couple of deals that I looked at, and I'm going to use some deals that came out in December. I know these properties have already been bought, renovated, and they're currently owned by Lifestyles members. So it really doesn't matter, but it gives you an idea of what you're dealing with. Now, keep in mind, this person has $60,000 to deal with. And this strategy that I'm going to talk about is based on that's all you got. That's all you got. You got $60,000. And it's a one-time injection of cash into your real estate deals, and any cash that comes out of that real estate deal, you're going to put right back in to real estate acquisition. It's a concept. It doesn't require you putting additional cash in the future. It's one chunk of money that you start with, and then you build that chunk of money over time. Now, this model that I'm going to talk about, it's kind of the slow way to do real estate investing. But for some people, it's the only way that they have. So I understand that. And this person indicated they wanted to build their wealth over the next 10 to 15 years. Now, our model really gets you on a glide path to doing it in 5 years or less. But they said 10 to 15 years, so I'm going to go with the 10 to 15 years. So it's based on the concept that there are properties out there that are worth $170,000 in after repair value. In other words, all fixed up, these properties will trade for $170,000 in the marketplace that they're in. Now, one of the properties you can buy for $102,000. The other property you can buy for $81,000. So what you're understanding is that the acquisition price is different on these properties, as well as the rehab costs. The property you can buy for $102,000 has a rehab cost of almost $44,000 with another $10,000 in closing and holding costs. So you're looking at about $54,000 in revenue streams that you need to pay for the associated costs of doing business in this property. But because you're going to do it the way we teach you to do it, your actual cash out of pocket on this deal is $28,250. $28,250. I know you're thinking, wait a minute, man, you just told me I'm going to buy it for $102,000. I'm going to rehab it for almost $44,000. I'm going to have closing and holding costs of another $10,000, but I'm only going to come out of pocket $28,250. Yes, that's essentially the way it works. Now, on the other property, you're looking at, again, a purchase price that's lower. It's $81,000. This property needs even more work. That's why you can buy it for even less. So you're looking at about $61,500 for the rehab on that second property, and about $10,000 in closing and holding costs. So, your total cost is pretty significant, but you can get into that property for just north of $29,000 cash out of pocket, because what you're doing is you're buying the properties using a hard money asset, which allows you to buy the properties and do some of the repairs so that as long as you're not exceeding 70% of the after repair value. Now, you're going to go beyond 70%. That's why you need to bring additional money to the table, but it's going to keep your cash out of pocket to a minimum. and it's going to give you the best possible returns on your investment. When we come back from the break, I'm going to get into those returns and how this investment can affect your life. Stick around.
Warning. Listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
So we're talking about taking $60,000 and using that money effectively to buy 2 single-family homes to get this person started with investing in real estate. Now, the email that I received said, hey, we were looking to buy a small multi-unit home to house hack. So I'm not sure what they mean. I don't know if they're talking about a duplex or if they're talking about buying a house and renting out rooms. It doesn't matter. But my scenario here essentially gives you a duplex, right? I mean, because you're buying 2 properties. Now, these properties aren't necessarily located next to each other, but they're in the same general market. As a matter of fact, these properties are located in the greater Houston market. What I want to get into, though, is the numbers, because I want you to understand how you can start with a nest egg of $60,000, and by preserving that capital, in other words, never spending the money or the money that money creates and allowing that money to compound, you can get to where you're trying to get to. If you had even more money, you could get there a whole lot faster. But we're staying with the kind of the slower approach and assuming a one-time injection of cash, and you're trying to get to a point of financial independence in 10 to 15 years. So here's the way those deals work out. One of the properties, based on what the rents you can command in the neighborhood are, will return a cash flow of $507 a month. $507. And that's on the property that's going to take $28,250 cash out of pocket. So when you annualize the rents, you're receiving over $6,000 a year in income streams that are protected to a certain degree by the depreciation write-offs that you will take on this property, meaning of this almost $6,100 you'll earn in rents, you're going to write off about $5,300 in depreciation costs. So your tax liability is only on about $770. So whatever your normal tax bracket is, you'll pay taxes on $768 as opposed to almost $6,100. Now that second property, it's actually in an area that can get a little bit better rents. So the cash flow projection on that property is $551. So when you annualize that, you're looking at $6,600 of income that you're receiving. You're writing off depreciation at $5,316. So your tax liability is only on about $1,300. Don't get hung up on the tax liability. Get hung up on the fact that these properties are producing cash flow for you. Now, we know that properties appreciate over time. They do. And we use a conservative number of about 3.5% to estimate what that appreciation should be. But keep in mind, there are some other important pieces of information that you need to understand. In that first property, you have about $42,500 in total equity in that property. And part of that comes from the fact that you captured $14,250 in additional equities. Yeah, it's going to get confusing for you a little bit, and I apologize for that. But I want you to understand that your total equity in that first property is about $42,500. That is wealth. Now, in that second property, it's pretty much the same thing, because these properties, when you marry up the loans that you can put on them, are basically going to have the same loan amount. In other words, you'll do a conventional takeout financing. Once you get all the renovations done, you'll cure that hard money loan, and you'll have a conventional loan with about $127,500 on each of these properties with a fair market value of $170,000. So you think about it, you've got $85,000 in equity in these two properties. Not to mention these two properties are producing about $13,000 a year in cash flow, of which your total tax liability is just barely against $2,000 of that. So that's to illustrate the fact that real estate investors get the best tax rates that are available to the taxpayers in America. It's just the way the tax laws are set up. I didn't create that. It's just the way it is. So let's assume these two properties, you're going to hold them for 3 years. And at the end of 3 years, you're going to sell the properties. Why is that important? Well, as I mentioned before, properties have the ability to appreciate. We like to calculate it at about a 3.5% rate. We keep it very conservative, but properties do have a tendency to appreciate even faster than that. So using that real conservative 3.5% rate, you're going to have about $18,500 in additional value on those properties at the end of 3 years because they will have gone up in price. You're also the beneficiary of the fact that as you pay those mortgages on those properties, a portion of that mortgage payment goes towards principal reduction. So as a result of that, there's an additional $14,000 in equity that you're going to garner. So what I'm getting at is this. You get to a point 3 years down the road and you decide you want to sell those properties. Well, those properties should have gone up in value and they should be on the market for about $188.5. That's what the market and my projection says that they're worth. So when you consider you've got $188.5, now stick with me here because I'm going to get through the wealth piece. When you have $188.5 on each property and your loan balance is paid down to about $120,600, your net equity at sale is almost $68,000 per house. Now, there are costs associated with selling the properties. I like to use an 8% number. That takes care of the 6% normally assigned to commissions. It takes care of 2% for other costs associated with the property. Now, your numbers might be bigger or smaller depending on what you do in 3 years. But your cost to sale on each of these properties is going to be right around $15,000, meaning your adjusted capital gain, that check that you're not going to get from escrow, and I'll explain the not in a minute, is about $53,000 per property. Yeah, $53,000 per property. Now, the reason you're not going to get a check from escrow is because you're going to decide to do a 1031 exchange. And you're going to trade into 4 additional properties. So you're going to sell 2, but now you're going to buy 4. Oh, yeah. And let me tell you where the money's going to come from. The monies that you receive from the sale will go to your 1031 exchange accommodator. They will escrow the money for you because the law says you're not allowed to touch that money. But you do have money set aside from all that cash flow because you've been building it up over those 3 years. So that is a significant amount of money. So when you take the net proceeds of the sale and you add 3 years worth of cash flow at about what did I say, about $13,000 per year, and you combine all that together, you now have almost $144,000 available to you to buy the next 4 properties. And if you run the numbers real quick, what you determine is that you can afford up to $36,000 cash out of pocket on each of the replacement properties. Now, you don't have to spend all of that because the 1031 rules basically say that your replacement properties have to just exceed the sales price of what you sold before. Yeah, it gets complicated. That's why I use a 1031 accommodator to make sure you're doing it right. But do you see the possibility here? And then if you do the same thing in 3 more years, you would have almost $288,000 and you would have sold 4 houses and you would buy 8. And let's say you held those 8 for 3 more years. Now you're at $575,000 in total money. You've done this at year 9. Now, if you stay on this path, if you choose to double again, now you're going to be at 16 houses that are producing about $1.15 million. And if you do it again, you double it one more time, you're now at 32 houses. That can be a lot of houses, but maybe you've got your system down. At year 15, and you'd have about $2.3 million. Now, with $2.3 million, you could buy yourself a really nice apartment complex. As a matter of fact, you could buy a really nice apartment complex at about the year 6 mark with that $287,000. So this gives you an idea of the possibilities. And really what it boils down to is really sitting down and understanding where is it you want to be in the next 5 years? And what do you need in order to accomplish that? Do you need cash flow to replace your income? Do you need equity captures so that you can increase your wealth and therefore buy more assets faster? I mean, it's kind of a complicated question, but we provide you solutions. And if you would like to see how we do business, go to freeworkshoplivestream.com. And remember, it's not the money, it's the lifestyle. Have a great day.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.